All right. Thanks everyone for joining this webinar this morning or afternoon or evening, depending on where you are globally. Of course, today we're going to be speaking on the global oil market and anything OPEC Plus related. My name is Reid Ianson. I am a senior economist here at Kepler. I'll be hosting this session. And of course, I am joined by Amena, who is our head of OPEC analysis here at Kepler, and Naveen, who is a senior crude oil analyst. Again, they will be taking us through everything that there is to know around the global oil market and also around OPEC Plus policy. Keep in mind, we'll have about 20 minutes of commentary and then another 10 to 15 minutes of questions at the end. Of course, as we go through this presentation, please feel free to go ahead and send in your questions, and we will attempt to get to them at the end of this session. With that being said, I'll go ahead and hand it off to Amena to start the commentary session of this webinar. Amena, off to you.
Thank you, Reid, and good afternoon or good morning to everyone. Thank you for joining us again for these webinars. And we're here again to kind of guide you through OPEC's latest move and to also shed a light on what might lay ahead in terms of OPEC setting its policy and what kind of drivers are behind the decision making. So obviously, the group of 8 producers offering the voluntary cuts, they met on Sunday and they decided to bring back the 548,000 barrels of unwind those cuts. And that was very much in line with what the market expected. And with that move, they finally announced the end of the first tranche of the voluntary cut, which is the 2.2 million barrels per day. And that also includes the adjustment that was given to the UAE, which is the 300,000 barrels per day. So instead of, the original plan was to unwind these cuts over an 18-month period. They managed to do it in a 6-month period. Now, there are some caveats to this agreement. They will be meeting again on the 7th of September. And given, how volatile the market is and the uncertainties we're seeing and the continuous, ahead of this call, we were just saying like how much Trump tweets, especially everything related to tariffs and the threat of losing supply, whether it's from Russia or other countries. So given all of these uncertainties, that these group of 8 producers still want to be kind of on top of what's happening. So on the 7th of September, when they meet, they will be assessing a number of factors. They will be looking at stock levels. Obviously, the price is one, supply demand balances. And based on that, they will choose either to pause and just wait, like just stick to the current agreement and see how things progress. They could unwind completely, like reverse the 2.2 million barrel per day unwinding, meaning that they will go back to cuts, or they could proceed with unwinding the next tranche of the voluntary cuts, which is the 1.66 million barrels per day, which currently is placed until the end of 2026. Now, they have this kind of wide range of options here. They wanted to share that with the market, saying that they are flexible in going in whatever direction. And there is also, of course, a movement that they don't want speculators to kind of impact this market. So that's why they're also giving this kind of wide range of actions that they want to do. But in our assessment, we think that they're most likely, given that, if we don't have any major changes and price levels are hovering around the same range we're seeing in Brent is around $68. Now, if things remain stable, most likely they would just sit on the current agreement, just wait for other signs before taking further action. And that's what we're predicting so far. Now, there are a number of uncertainties, as I mentioned, and one of them being how these new tariffs that Trump is talking about impact Russian supply. And my colleague Naveen will take you through a few slides here, but just talking about that, it's just too early to say how much India is going to be impacted. But if it seems like a different situation. It seems like if we do get secondary sanctions, we might get a loss of some of these Russian imports by India. Now there have been inquiries by Russian refineries to Middle East suppliers, but it's still in the kind of very, very early phase. And when I'm talking about state refineries, they're still very much looking at the bargain barrels. They're still very much sensitive to prices. So they are still buying Russian crude, and they are not receiving discounts from the Middle Eastern suppliers. That situation might change very quickly again if Trump decides to press ahead with more stringent sanctions or secondary sanctions. And India is very much exposed to the U.S. financial system, so we might see a completely different situation there. Now I'll hand this over to Naveen, and maybe you could take us through to some of the slides that we have on the topic.
Yeah, perfect. Thanks, Amina. Thank you everyone for joining as well. As Amina mentioned, that's the kind of the status quo, the state of play in terms of OPEC. I'll quickly go through what that means on a sort of, on a numbers basis. As Amina said, the first layer has been unwound in sort of record time very quickly as well. Overlaying that, we've seen a variation, you'd say, in terms of their exports, stronger exports in June with a bit of a pullback as well in July. And that's sort of linked to how the policy has sort of evolved. On the right-hand chart here, you see the final tranche slightly less than the headline number. I think we've mentioned this in previous webinars. That sort of accounts for some of the compensation plans as well. But crucially, what happens now, what happens next is related to a couple of factors. One, the internal demand, within the Middle East in terms of how much has been processed by their own refiners. And once the sort of seasonal element abates, where does that leave us from a supply and demand balance for OPEC barrels? So sort of what they produce and what they sort of consume. We're seeing an average gap now going into the end of this year, the beginning of next year, of around 1.75 million barrels. That's a huge number. Obviously, there's many factors that can change this going forwards, but these are the sort of factors and elements that OPEC will be looking at. And part of the elements that made them quite successful, I'd say, in accelerating their output, bringing it back at a time when these barrels could be absorbed, and as a result, the prices have held up. Part of the strategy has been, as I said, the domestic crude burn. So Saudi Arabia being one, the May sort of Jody data for Saudi showed, quite robust fuel oil and crude oil burn. The fuel oil imports into the Middle East have sort of dropped off since then, but we've seen the crude burn accelerate. So the chart on the left, as official data comes out, probably subject to crude burn levels being even higher. And paired with that, I mean, it's been unseasonably hot. Even Amina was telling us before this call that how hot it's been in Dubai. Unseasonably hot, quite a lot of desalination and demand for water as well. So that crude burn has really been quite pronounced at a time when fuel oil cracks have been positive, so sort of incentivizing crude burn. But to sort of marry that and looking at the Far East, it's also come at a time when Chinese buying both for refining and for their both commercial and SPR inventories has been climbing. Month on month in July, we're seeing sort of Chinese refinery runs up by about 400 kbd. But notably, there's also been a bit of a shift in the teapots. Their sort of consumption, tax rebate for fuel oil has been increased, sort of incentivizing ramp up and runs. We've only seen a sort of 2 to 3% tick up in teapot refining and utilization. Nonetheless, there is this tension between the central government in China and regional governments, whereby the central government wants to sort of suppress these teapot runs, but they are sort of vital for regional economies. So there was a recent acquisition, I think Changi Petchem, which was a 300 kbd refinery back online. So there is scope for those runs to stay high, but a combination of these runs and the crude inventories, we'll touch upon this a bit later, have been sort of crucial in absorbing barrels this summer, keeping the market quite supportive at a time when OPEC was bringing back barrels. So these are some of the factors that have led us here. I think the big question now on everyone's sort of minds and lips is what happens with this sort of US, India, Russia interplay. I mean, throw into it the EU sanctions package. I mean, the meat of that was sort of going to come into effect in January 2026, but there are some interesting details around that as well. For now, it does seem there has been an effect in a certain sense, as Amina touched upon. We've seen Indian refiners try to, look for the cheapest crudes on a delivered India basis. It's a strategy they tried to employ quite a lot. Good evidence of this was the sort of Mangalore refinery picking up some Azeri crude when those diffs are falling off due to the organic chlorine issue that was present in the recent past. Nayara, their refinery, sort of trimming run rates as well, linked to the potential for sanctions and secondary tariffs. And as a result, there's been a short-term pivot away towards more Middle Eastern barrels, which has kept that has kept Dubai sort of supported relative to Brent. There are several moving parts here with this. As you know, our personal view is that, even though these barrels will probably redirect or find a flow, or there'll be some sort of reconciliation. The timing of this from the US and from Trump's side is quite pointed. There's obviously been some domestic issues in terms of, for example, the Epstein files and the fact that the the handling around Russia, Ukraine hasn't painted Trump in the best light. He's been a bit weak on that, some may say. And the sort of the advancing of that deadline on Russia from the 50 days to the 10 to 12 days is a fair statement of intent. There's also the spikiness around the India and US trade deal. This could be a sort of a gambit to try and push India to source more US crude. But on a weekly basis, the flows of Russian have remained relatively stable, a little bit of a tick down, still around 3.3 million barrels per day. But I think crucially, the chart on the right here, you've seen that delivered India Urals price really kind of falling off a cliff. For those of you who are subscribers, we had a really in-depth piece about that very recently. But as I said, there's several moving parts to this, and just to lump on the sort of the EU sanctions element to this, there's a loophole in that as well, which sort of suggests that countries that are net exporters of crude already could process Russian barrels and bring those sort of products from that into the European Union. This obviously coincides with a time when domestic refining capacity in Europe has been dwindling. For example, take the 120 KBD Lindsey refinery that went into sort of liquidation. So given the global dearth of gas oil and middle distillates recently, it is interesting to see how these Russian barrels flow, and the sort of continued need for products to be produced, and for desired grades for refineries to get these products to where they need to be. So whilst we think there's still a shorter term disruption, like many of the other times we've seen these threats around Russia, this time could be slightly more serious. And quite interestingly, on a flat price basis, there was quite strong technicals on Brent flat price, the 200-day moving average acting as a quite a decent resistance. But we sort of popped above that 70 level when President Trump said that prices weren't that expensive, and that was enough of a catalyst to pop us higher. Subsequently, as Amina said, Brent trading at around 68. Some uncertainty around this Russia-India situation, with India sort of biting back, saying that they won't back down in a certain sense. The central government has not issued any sort of directive to refineries to stop buying Russian crude. And combined with the OPEC plus supply hikes, we've seen that price downturn. But it is interesting to note that the US, Russia, India narrative for now is the primary catalyst, it seems, in terms of determining direction. But given how complex this is, we don't really see any much conviction around it. or much direction. One thing to sort of keep in mind is, Russian crude makes up about 37% of the market share into India. It's quite difficult to sort of replace that, especially if there's long-term contracts for Middle Eastern crudes going to the Far East. There's also freight considerations. And in a wider sense, redirecting these flows, be it a short-term disruption or a longer-term disruption, there's a balance between, the inflation concern in the US, the desire, at least for the Fed to sort of cut rates as well. So quite a delicate interplay there. So I just have two quick slides to finish up before we can go into questions. But what does this all mean, really? Our balances suggest, as we've shared before, a significant lengthening going into Q4. Again, significant caveats to that with the sort of the Russia situation, with the sort of robust refinery runs there's been around the need for middle distillate as well. A few just things to sort of highlight around here. Prices have sort of held up because of the sort of lopsided nature of how inventories are built. Global inventories, especially in the Far East, as I mentioned before, China growing quite rapidly, whereas on the OECD side, we are seeing that they haven't sort of appreciated or are staying near lower seasonal or longer term levels, which has allowed for that backwardation to sort of persist in the market. A few quick features here. We've seen recently a bit of a ramp up in the Dos Bocas refinery. We're seeing it maybe around 185, 190 KBD operation. So something to sort of factor in from the demand side. But nonetheless, recent official data showed that non-OPEC producers, that was sort of the big story coming into this year, how robust they're going to be, that those supplies are hitting, fresh heights. We're expecting fresh sort of FPSO supply coming out of Guyana, adding about 250 KBD to our Guyanese supply forecast. Brazilian output reached all-time highs in the official June data, around 3.76 billion barrels per day, and US official supply figures for May coming in at 13.5 million barrels per day. So all remaining robust, all factoring into our balances, which should see a lengthening and therefore a cascading sort of knock on onto price. However, we have moved our price forecast up because of the additional inventory buying from China, the stronger refinery runs both in the Middle East for crude burn, but also to sort of address the global gas oil supply. There was some tightness in the resid space, which altered the light and heavy crude dynamics as well, and that played on regional benchmark prices as well. So whilst we've boosted our price forecast, we do see a decline. We've also made it a bit more shallow, taking into account the places where this S&D balance could show cracks or where the market will potentially correct for the prospect of a big lengthening in Q4. So I'll just leave you with a few what we call trading flags and themes and watch points, things that we are looking at acutely, sort of discussing and trying to get the data behind. Firstly, of course, the evolution of these Russia-related tariffs and sanctions. How does that play out? As I said, it seems it might be a bit more serious than previous times. But again, it is very Trump-related, and there is the backdrop of the separate US-India trade deal to sort of caveat how that progresses. These Chinese inventories, the rationale behind stockpiling is a very interesting one, and we'll see how that sort of progresses into the fourth quarter. In the past, they have said that at times of geopolitical tension, it is their aim to sort of build up crude stockpiles. So, what that means for the global geopolitical setup come Q4 is an interesting question that we've been sort of wrangling with as well. If we do see a downside in price, where does that leave both sort of US supplies, but also the potential for US SPR refill? Again, linked to how the geopolitical landscape shifts and the need to sort of build up additional inventories. In a downward price spiral, or, a flattening curve structure. Again, if we're looking at the fundamentals, being built up and the lengthening, we should definitely see that take place in the backwardation or the structure in the market. In that sort of scenario, who are the suppliers that start creaking a little bit? are the creeks starting to come from within the OPEC plus group, the likes of Russia, the likes of Iraq? How do they remain as robust to supply in a lower price environment, and how long could they sustain a lower price environment should we get there? And one final thing to sort of flag is the general macro landscape. What happens with the Fed and their rate cuts, the progress or the evolution of the US dollar index. And an interesting thing that was sort of flagged up in the macro sphere quite recently is the credit spreads around corporate bonds, reaching sort of fresh low levels, the lowest since the financial crash. Sort of indicating a little bit of maybe complacency around the general health of the economy or the macro space. It seems like there's not as much hedging going on there. So potentially setting us up for a bit of a macro wobble should, again, the Trump-related, tariff-related, sanction-related factors all take hold. Thank you for listening. We'll pass it over to some questions now.
Awesome. Thanks for that, Naveen. Yeah, we're going to spend about 10 minutes taking some questions. Amena, I'll go to you first. Again, as we've done on a number of these calls in the past, just basically set the scene. Where do you think OPEC Plus policy is going from here? And what's the significance of the policy moves taken over the last couple of months?
Thanks, Reed. Well, just looking at their own numbers, which of course, I mean, obviously they tend to be on the very, very bullish side. So based on their demand numbers, what I could see is that their balances show that from Q3 to Q4, they have an increase in demand of 900 KBD. That would get us to around 106.4 million barrels, and that would suggest that additional supply is needed. That's going by the Secretariat's numbers. Now, according to our balances, as Naveen indicated, we have quite long balances. We see a lot of supply coming from outside the OPEC Plus group, so there is a risk there that we might see prices kind of catching up with the fundamentals and see a different picture. And that's why I think the group is being really cautious. They don't know which way it's going to go, so that's why they're giving us this really big range of options in terms of where they take their policy. But as I mentioned before, I think for the time being, they're just going to observe how the market reacts. And it seems like Trump, I mean, Naveen said, I mean, and today again, I'm seeing Trump tweeting that he's okay with oil prices being at this level. So maybe $70 or $68 is the new 50. So being comfortable with this level, it means that maybe it would be maintained at that level. And they're just going to be more of I mean, they do take proactive steps, but they're most likely, which I think they're just going to observe what happens rather than making another change, unless we have a completely different scenario where, we're in a different space and we have completely different prices where they need to react to. But for now, I would say they'll just wait and see how that latest move impacts the market.
Got it. And just to stay with you, this is a bit of in the weeds question, but one relevant for you, Amena. Just, is there a mechanism for monitoring production compensation for specific countries?
Yeah, great question. Unfortunately, the countries that do have compensation cuts haven't been publicly reporting how much compensation they're going to be doing in the coming months, which kind of makes it a little bit more tricky for us as a secondary source and other secondary sources to do these calculations. But we just see repeatedly in statements that compensation cuts will continue. What I can tell you is that just from the numbers, looking at the numbers, the actual headline figures of how much OPEC announced that they will be increasing the production ceiling, these are not actual barrels that are coming into the market. We're seeing physically there's less supply coming into the market compared to those production ceilings. So if I look at April, May, and June, for example, I would say that 30% hasn't been realized out of the total headline numbers. So there are compensation cuts, and countries are still kind of continuing to do that. The only country that's failed their compensation cuts repeatedly is Kazakhstan, and I don't think that's going to change.
Got it. Naveen, we're going to come to you. A lot of questions on what's going to happen with India. I was looking at Kepler data earlier today. India's purchasing, 1.5 million barrels of crude from Russia every day. One, kind of just are they, do you see a chance that they cut these purchases? If that were to happen, would there be an alternative home? If not, kind of where do you see price going? Uh, I'll hand it off to you.
Sure. Again, a great question. I think one thing to consider with this is obviously the timelines of what we're talking. I think there is we're seeing potentially a short-term disruption. And you're right, it's 1.5 million barrels a day, sometimes upwards of 2 million barrels a day of crude, Russian crude coming into India. I think in terms of a complete change of slate or a complete shift away, taking 2 million barrels of Russian crude away from the Indian market is a monumental shift. And the sort of logistical, insurance, freight implications of that suggest that even if we were to not lose those barrels and they were to be shifted elsewhere, you're going to see quite a significant price upshot whilst the Indians seek out, significant volumes of crude to replace it. So I don't think logistically that is very possible to achieve. I think China could absorb more barrels. We were speaking internally, just this morning with our sort of key China analyst, and she was mentioning it could be maybe upwards of 500 kbd of additional Russian barrels going into China to make up for it. But then again, you are left with this pocket of call it 1 million to 1.5 million barrels of Russian crude, if we're saying that it's not going to go to India, that needs to go elsewhere or is locked away from the market. So in a situation where it's locked away from the market, we go back to almost the panic around the beginning of 2022 when we were thinking that we'd lose a lot of Russian barrels from the market. But ultimately, we do find the oil market finds ways, either through, different credit lines or different mechanisms or loopholes through insurance or freight to ensure that these barrels move and find homes. So I still think there will be a scenario in which India will continue to buy Russian crude. There could be maybe some small disruption, and whether we see a redirection of flows, I think there could be sort of a small redirection of flows if certain sort of state-owned refiners pivot away slightly from Russian, but nothing monumental to to show a complete step change in a sense for the market.
And just to kind of follow up to that, are most of these barrels flowing into India being traded spot? Are there some term contracts there? Do you know?
I think it's a mix. As I said, as Amina touched upon, before, the delivered India price is extremely. I mean, that's the critical element to that. When you're building up your arbitrage calculations, when you're looking at the different costs, taking because of sort of higher, maybe sometimes internal logistical costs within India, getting your crude to a port at the lowest possible price, again, that is amenable for your refiner is the key. So I think there is a mix of spot buying and term contracts. I think even the Indian oil minister said in the past that they remain very flexible, very nimble, and they're always seeking out sort of opportunities. So we've already seen that in the very recent past. They've, as I said, opportunistically bought spot crudes, spot Azeri light at the times when prices have dropped. There's been big tenders for to WTI, some crudes from the UAE as well. So I think it is a mix.
Got it. And just to honestly stay on this India question, I think because that's a lot of the focus of the questions coming through. Amina, has there been any outreach from the Middle Eastern OPEC members saying, "Hey, we'll provide more crude to you, India"?
Yeah, I think there has been, but again, it's down to the price, Reed. And the Middle East producers are not willing to discount their crude as much as the Russians have. And India is very sensitive towards that. And I think the bargain buying is still going to prevail. And that's how they maintain their kind of energy security. And that's why we saw that really strong statement from the Indian government yesterday as a response to all of Trump's statements. So yes, there have been some inquiries, but I don't think the entire volume, that huge, I mean, up to 2 million barrels a day of Russian crude, that can't be replaced by the Middle Eastern producers. Part of the reason why we're also not seeing, I mean, we're seeing these headline figures that I talked about, those increments announced by OPEC Plus, not being realized. Yes, sure, you have the domestic demand increase, more crude burn, and then you have the compensation cuts, but you also have capacity limits. You have some countries almost reaching, you're going to reach that point where these countries are going to reach their capacity limits. I would say maybe like Saudi Arabia and the UAE, or the countries, or even Kuwait to some extent, have spare capacity that could immediately be tapped into. But all the rest, we are going to reach a point where you're not going to have the spare capacity. So you can't replace that entire volume with just Middle East crude.
Got it. Naveen, one last question here to close it out. Just any final comments on the state of prices right now, where obviously you mentioned our price forecast, but just any final comments on the structure of the forward curve and of spot prices right now?
Yeah, I think, as I said, we shared our recent forecast, and we've moved it higher, and we've, crucially, shallowed out the structure in that sense, to sort of taper off the way in which, the S&D is going to change. Yeah, I think as I highlighted in the last slide, there's a lot to go through. There's a lot of things to process. Again, the fundamentals are just one element of this market, and has been proved time and time again. Um, we're looking at the technicals to see how they perform. We're looking at the macro environment. What I would say is, I think at the end of the day, this is, a lot of the benchmarks are physically settled. You need to be able to sort of account for where the oil is going, where the barrels are going. And, it does seem like we will be building inventories going into Q4. So we do see sort of this drop in price. But, one last thought to sort of leave everyone with is, I think, given how robust cracks have been, how forward margins are looking, I think a lot of refiners have probably hedged their Q4 cracks, or even going forward. So even if margins start to wobble a little bit, I think we should see refineries, continue to have quite strong crude throughput. So I think there's a bit of a cushion to the downside. I think we should see prices decline. But, as we've seen this so far this year in the market with President Trump in the seat, these things can change, at the drop of a truth social post. So let's see.
High amounts of uncertainty.
Yes.
Yeah. Awesome. Well, we'll go ahead and call our webinar here, guys. Again, thanks for joining. For those of you who are not subscribers to Insights, we put out deep amounts of research across a number of commodities each and every day. Reach out to sales@kepler.com. If you don't have access, we can get you some trial access. And of course, if you are an Insights member, you can watch this recording and read any of our insight at any time. With that being said, thanks for joining, and we'll see you again next time. Bye-bye.